red stories on the Bloomberg today. Brian, I mean, so many parties, whether you're savers, companies, and so on and so forth, banks are sort of rubbing their hands with glee after this big ramp up in bonds we've seen. I mean, let's start with companies, especially those companies who have got liabilities in their defined plans. This is a huge relief, isn't it?
It really is, because they've really had to shift into stocks or other alternative assets to make up the lack of income that they were getting from their fixed income investments. And according to Milliman, who I interviewed, this is going to reduce those future liabilities by $100 billion, the half a percentage point increase in interest rates already. So that's a huge reprieve. They can start shifting back into bonds and starting getting that fixed income that is, you know, what bonds usually are used for, rather than the sort of price returns that we've seen so much over the past few years.
And it doesn't end there. I mean, the bankers, we've just seen it in the stock price performance, haven't we, Brian? You know, this shift into industrials, this shift into banks, this net interest income finally could have something happy for investors all the way around.
Right. For a long time this year, it was just flatter yield curves, and it was really tough for banks to make any sort of profit between, you know, off of their investments relative to their lending rates. So it's just a really huge benefit to the banks, and also a help to the savers, just the individuals who are risk averse, want to park their money somewhere and get some sort of income. This is a huge relief after the year that we've seen.
Well, so yields on the 30-year Treasury bond up about 50 basis points since the election. That's what you're referring to. That's a real boon for savers. But what about those savers that were trying to be a little bit more active about where they put their money and perhaps took their money out of some regular safe index funds and put them into more emerging market type funds?
Well, those have been hard hit. I mean, there's no sugarcoating it. I mean, the move hurt a lot of people. But the question is going to be, you know, going forward from these levels, it gives people an opportunity to make up the difference as far as returns, because when the price goes down and the yields go up, it is painful, but ultimately it's a benefit because you can lock in higher rates for a long period of time.
Well, so for things like pension funds and, you know, I'm thinking CalSTRS, CalPERS and so forth, there are mandates to have a certain amount of their AUM in treasuries, in US treasuries. What's the typical amount that they would hold?
I'm not exactly sure of what the amount they hold is, but they do. Ideally, they would want to have a huge allocation to bonds. In a perfect world, they would just buy bonds, immunize themselves from any sort of price swings in the market, and just have enough assets to meet their liabilities long term. So that's their ultimate goal. But the problem is because of these ultra low rates, these ultra depressed rates, they've had to sort of readjust their asset allocation and potentially take more risk.
Brian, great story. In bond traders' Trump nightmare, some big winners emerge. One of the most read stories on the Bloomberg today. Vonnie.
Well, still ahead, Mark. It's proposal season, did you know? We'll talk to the CEO of a public wedding company about the $100 billion business of weddings. This is Bloomberg.